Singapore is in the middle of this massive construction wave, and today we're digging into an analyst report that points to one key company laying the groundwork for all of it, Reclaims Global. We're going to break down the investment case from UOB Kay Hian and see if there's a real opportunity here. Let's get right into it.
First up, let's just talk about the sheer scale of this thing. In 2024, Singapore's construction demand is set to hit a staggering $44.2 billion. That's billions more than anyone even predicted, so we're not talking about a small uptick here. This is a full-on boom, all thanks to mega projects like Changi's Terminal 5 and the Tuas Mega Port. And a number like that, well, it creates a massive opportunity.
So okay, with a market that huge, the big question for any investor has to be, who's going to benefit? Who's actually on the ground, moving all that earth, and getting these huge projects off the ground?
And that's where Reclaims Global comes in. According to this report, these guys are one of the top 3 players in earthworks and excavation in the entire country. They're literally the foundation layer for this whole construction boom.
Now, what's really interesting here is their focus. Just look at this breakdown. Over 75% of their entire business is just excavation services. This isn't some company trying to do a million different things. Nope. They are specialists in the very first, and you could argue, most important part of building anything.
And this gets to a really key part of their business model. They're in a very low-risk position. Because they handle the initial groundwork, they're one of the first ones on site. And, this is crucial, one of the first to get paid. Being at the front of the line like that means their risk of not getting paid is extremely low, which is a really attractive quality for any investor.
All right, so we've got a huge market and a key player who gets paid first. Let's dive into the bull case and see how the numbers actually stack up when we're talking about this as an investment.
And wow, the numbers are impressive. Just take a look at this chart. In fiscal year 2025, the company's revenue didn't just grow, it absolutely exploded. We're talking an incredible 82.7% jump in just 1 year. That's the kind of momentum that makes you sit up and pay attention.
And on top of that wild growth, their balance sheet is just rock solid. As of fiscal year 2025, Reclaims had $18.5 million just sitting in cash. And here's the real kicker, 0 debt. They paid it all off. That leaves them in a really powerful net cash position.
So the crucial thing to get here is this isn't just some one-off lucky year. The report lays out a really solid foundation for future growth. I mean, they're perfectly positioned to ride this construction wave, they've got a pipeline full of long-term projects, and their financials are just compelling. You're looking at a high return on equity of around 17%, a stable dividend that's yielding about 5%, and they just raised more money to take on even more work.
Okay, that's a pretty compelling story, right? But you know us, we have to play devil's advocate. Let's put on our skeptic's hat for a second and see if there are any cracks in this foundation. I mean, with growth like that and a balance sheet that clean, you've got to ask yourself, is the picture really this perfect? Is there something the market is missing here?
And this is where it gets really fascinating. Let's look at how Reclaim stacks up against its competitors. The forecast for fiscal year 2027 shows Reclaim's trading at a price-to-earnings ratio, or PE, of 8.7. Its competitors? They're trading at an average of 10. So right off the bat, it's cheaper. But get this. Look at the return on equity, or ROE. Reclaims is delivering a higher return at around 17%, while its peers are under 15%.
Let's just put that plainly. The company is more profitable than its competitors, but the market is pricing it at about a 20% discount.
And that is the million-dollar question, isn't it? If the company is a market leader with amazing growth, a great balance sheet, and it's more profitable, why on earth is it trading so much cheaper than everyone else? The analyst report basically argues that, you know what, this discount doesn't make any sense.
Which brings us to the bottom line. After weighing this incredibly strong case against this really strange valuation discount, what's the final call from the UOB Kay Hian report?
Well, the analysts don't see this momentum slowing down one bit. They're forecasting steady, consistent growth in both revenue and profit for the next 3 years. They see the company just getting stronger and more profitable every single year.
And so they answer that big valuation question with a very clear, very direct conclusion. They're initiating coverage with a buy rating, basically saying the market has this one wrong and the stock is undervalued.
And this chart right here, this really puts it all into perspective for an investor. At the time of the report, the price was around 40 cents. The analyst's target price, 56 cents. That is a potential upside of over 38%. They believe that valuation gap isn't a weakness, it's a huge opportunity. So at the end of the day, after digging through this whole report, we're left with this question. You have a market leader in a booming industry with explosive growth, a fortress of a balance sheet, and a valuation that suggests there's a lot of room to run. The real question for you to consider is this a company ready to build a solid foundation for your portfolio?